all the major companies such as Microsoft, Meta, Tesla, all of them have taken venture debt, as some part of their growth journey. Now, why have they turned to venture debt, all of these being large companies, is simply because, depending upon the sector you are in, especially sectors such as fintech and EV, which are very capital intensive in nature, you cannot just fully rely on equity for all your growth journey, because let's say you have to spend $500 million in investing in a manufacturing plant, which Tesla did. You cannot fully rely on equity because all the existing shareholders, including the founders, will get heavily diluted. So today, what we have seen...
You take bank loans, right? How does venture debt help?
Yeah, but banks typically do not lend to companies which are loss-making, which most of the startups which are very early in their growth journey are. Especially when you look at newer sectors such as fintech and EV, there is a lot of regulatory uncertainty across these sectors, which banks therefore typically prefer to avoid. And that's where...
There's always asset collateral to back that, right, for a lot of banks?
Yes, but asset is just one part of the equation. You also look at income statements, cash flows that the underlying companies are generating. That's number one. And number two is, again, from a sectoral point of view, a lot of banks would typically avoid entering early into sectors, which have not fully developed. So again, fintech and EV being two such sectors in India, which are still very at a developing stage. And you would have seen that there has been a lot of regulatory uncertainty in fintech, be it especially what happened with Paytm and, in EV sectors as well with the subsidy crisis. So therefore, a lot of banks prefer not entering into these sectors until there are stable regulations and the companies are cash flow positive. And that's where alternative lenders such as venture debt comes in. And this has been the trajectory globally. In India, over the last 10 years, venture debt has, blown up. Today, almost all companies that are looking to raise capital are preferring venture debt as part of their round, especially capital-intensive sectors such as fintech and EV, which we covered as part of our report.
And, of course, in our lead-in, we did highlight that a lot of companies also choosing venture debt to avoid excessive equity dilution because founders want more control of their business. Does it really work like that? Because I was given to understand that some of the debt is convertible debt in the form of warrants. So how does that work? What is the preferred instrument? Because warrant conversion then again leads to you guys ultimately having, the best of both worlds.
Yeah.
Returns on the debt that you provide through interest rates, and then also getting a stake after a certain point in time for when the company goes and gets listed.
No, that's a great question. So that's not the way, however, venture debt works, right? Venture debt typically do have warrants, but they are a very small percentage of the overall financing. And the idea of taking warrants is essentially because venture debt lenders are entering at a stage, when the companies are fast growing and have some form of a business risk, to mitigate that risk. That's the reason why venture debt lenders prefer sharing in the equity upside as well. That's number one. Number two is typically the cost of financing in US dollar terms overall for venture debt typically hovers somewhere around 17 to 18%. And if you mix, debt and equity, you can reduce the upfront cost of financing, for the companies by having some back-ended equity kickers. Okay. So that's the reason why the companies, are willing to give warrants, because as a percentage terms, it's still cheaper than, fully diluting equity. Now, venture debt actually started as a non-dilutive capital for founders to preserve equity, right? Okay. But over the last 3-4 years, what has happened is because of the funding winter, a lot of VC firms slowed down, their pace of investments. And therefore, for startups, who were still looking for growth capital, they started turning to venture debt. So now, as per our research, almost 2/3 of the company prefer borrowing from venture debt rather than banks, simply because venture debt lenders are faster. And because, we ultimately being an alternative lender, we are able to quickly move, unlike what traditional banks, can do. So therefore, if you look at today the use cases of venture debt, they have exceeded not just being as a non-dilutive capital, but startups are genuinely looking at debt for growth. Again, to re-emphasize, fintech and EV sectors being the most, backed companies from venture debt lenders, for the simple reason that fintech capital is growth for them, especially if you're into lending. And for EV, it's a capital-intensive nature. So therefore, you need to mix some leverage as part of your growth journey.
So